Accounting is built on trust, accuracy, and integrity. However, financial professionals often face ethical dilemmas that challenge their judgment and decision-making. Whether due to pressure from management, conflicts of interest, or legal gray areas, accountants must carefully navigate ethical challenges to protect themselves and their organizations. Mishandling these issues can lead to legal trouble, reputational damage, and financial losses. Here are the top 10 ethical dilemmas in accounting that could put you at risk. 1. Misrepresentation of financial statements. One of the most serious ethical issues in accounting is intentionally misrepresenting financial data. Whether it's inflating revenue, understating expenses, or hiding debts, misleading financial statements can lead to fraud charges, regulatory fines, and lawsuits. Ethical accountants must ensure that financial reports are accurate, transparent, and compliant with accounting standards. 2. Pressure to manipulate earnings. Many companies face pressure to meet revenue targets, and accountants may be asked to adjust numbers to make financial statements look better. This could involve delaying expense recognition, overestimating revenue, or using creative accounting techniques. However, such actions violate ethical standards and can result in severe legal consequences if discovered. 3. Conflict of interest. Accountants often deal with situations where their personal interests or relationships could affect their objectivity. For example, an accountant auditing a company where they have investments or family connections creates a conflict of interest. Ethical accountants must disclose conflicts and remove themselves from situations where their judgment could be compromised. 4. Insider trading. Access to confidential financial information puts accountants in a unique position, but using that information for personal financial gain is unethical and illegal. Trading stocks based on non-public company data can lead to criminal charges, fines, and loss of professional licenses. Ethical professionals must keep sensitive information confidential at all times. 5. Tax evasion and avoidance. Businesses rely on accountants to legally minimize tax obligations, but some cross the line into tax evasion by falsifying records, hiding income, or inflating deductions. While tax avoidance, using legal loopholes, is permissible, tax evasion is a criminal offense. Accountants must adhere to tax laws and avoid unethical practices that could lead to penalties or audits. 6. Fraudulent expense reporting. Accountants are sometimes pressured to approve or overlook false expense claims, such as inflated travel costs, personal expenses disguised as business costs, or unauthorized reimbursements. Turning a blind eye to fraudulent expense reports can lead to legal consequences and reputational damage. Ethical accountants must enforce strict financial oversight to prevent such misconduct. 7. Bribery and unethical influence. Some businesses attempt to influence auditors or financial professionals through gifts, favors, or bribes. Accepting such incentives compromises professional integrity and can result in legal trouble. Ethical accountants must follow anti-corruption laws and avoid any transactions that create a perception of bias or dishonesty. 8. Non-compliance with regulations. Companies must follow financial reporting laws and industry regulations, but some accountants may be asked to ignore or bypass compliance requirements to save costs or avoid penalties. Failing to comply with regulatory guidelines can lead to fines, legal action, and loss of professional credibility. Ethical professionals must ensure that all financial records meet legal and industry standards. 9. Ignoring whistleblower reports. Ethical accountants have a duty to report financial misconduct, yet many fear retaliation if they expose fraud or unethical behavior within their organization. Ignoring whistleblower reports or failing to act on financial wrongdoing can lead to legal liabilities and loss of professional integrity. Whistleblower protection laws exist to encourage ethical reporting without fear of repercussions. 10. Overlooking internal control failures. Companies rely on internal controls to prevent fraud, financial mismanagement, and errors. Accountants who fail to implement or enforce proper internal controls put their organization at risk. Weak internal controls can lead to financial losses, fraud, and legal consequences. Ethical accountants must actively promote strong financial oversight to prevent misconduct. Ethical dilemmas in accounting can have serious consequences, from financial penalties to career-ending legal troubles. Accountants must uphold integrity, transparency, and compliance to ensure ethical financial reporting. By making ethical decisions and following industry regulations, professionals can protect their reputation, business, and stakeholders from legal and financial risks.